Exchange-traded funds are transforming the way we invest. They provide very cheap access to almost any market you could think of. So I was delighted when I found out that Eric Balchunas, who's a senior ETF analyst at Bloomberg Intelligence, had agreed to an interview. Here he dispels some of the myths about ETFs and describes the transformation which they're undergoing as they move towards ever lower fees. So here he is describing ETFs in his own words. Well, it's a great pleasure to introduce you, Eric Balchunas. I listened to your podcast, which is called Trillions, and you've just written a book called the Institutional ETF Toolbox. Maybe we can talk about that later too. So maybe we could start off really simple, and maybe you could explain exactly what is an exchange-traded fund.
Sure. I think for most people who know the mutual fund, it's essentially a mutual fund that you can just trade on an exchange. There is something called the creation redemption process, which we call ETF mechanics, which I highly recommend learning about. But this creation redemption process is sort of the heart behind why ETFs work so well. But not getting into that right now, I think for most regular people who are retail investors, I think the key to know is that the ETF is structured much like a mutual fund where you've got independent board of directors. The stocks that are in it are stored with a custodian. So it's not a derivative where you're counting on a counterparty. There's transferability. So that level of security and fiduciary element, I think, is what makes it so strong as a product. Yet it does have traits like a derivative. You can get in and out of it very quickly. So it kind of brings together the best of those worlds. But ultimately, as my friend and colleague Reggie Brown of Cantor calls it, it's a mutual fund with benefits.
I love that. And you also have this lovely analogy with an MP3. Do you want to just go through that? I think that's a great way of explaining it.
Sure. So I'm a big fan of music, and I was a huge CD collector. Spent a lot of money on CDs, especially in college. And the MP3 came around, and now I do not use CDs at all. And I was really into them. And I find that the ETF is much like the MP3 in that it isn't an asset class or a sector. It's just a portal to get to those things. So just like I'm still listening to Radiohead, Bob Dylan, some new indie rocker bands, my latest is Kurt Weill, I'm just doing it through MP3s now and picking my battles. I know some of the streaming is the new thing now. I'm still an iTunes guy. I like to own it, but still, I probably spend a tenth of what I spent on music now. I get to pick and choose my songs. It's more flexible. I can jog with it easier. In other words, just like the MP3, it's a cheaper, more flexible way to get what you were getting in the past. So that's why I think it's much more equatable to a technology or a portal than it is to an asset class, because I sometimes will hear people say, there's a passive bubble or an ETF bubble. They kind of conflate an ETF with an asset class, where they'll say it's like the internet bubble. I'm like, no, the internet bubble was stocks. Again, the ETF is much more akin to the mutual fund, which I think are akin to ways to get to asset classes and stocks or to get at exposure. And I think the MP3, the other metaphor that works there is that the MP3 cut the music industry's revenue in half. And I believe the ETF ultimately will have that effect on the financial industry down the road.
So I guess in a sense, it's just a wrapper. Yeah.
That's it.
Okay, so let's just talk briefly about your brilliant way of coining phrases, because you've got another thing which is based on your musical taste, which I have to say is slightly dubious, which is Terrordome, the hashtag Terrordome, which fascinates me. Could you explain that?
Yeah, Terrordome to me just reminds me of just a scary place. And there's a Public Enemy album called Welcome to the Terrordome. And, these guys are rapping from a place that's a little, not the best neighborhood, right? So I equate it to that. I've sometimes referred to the ETF jungle. I also think of Mad Max images come to mind when I think of ETFs, in the fee war. And the reason I say that is because mutual funds come with loads that pay brokers to put people in them. So that's very helpful if you're a mutual fund company. You're actually paying people to put your clients in there. Now that the world has switched over to fee-based advisors, where they don't get paid by the mutual fund company, but rather they get a percentage of their clients' assets. They now want cheap products. And so a lot of the clientele of ETFs are just ridiculously stingy and picky investors and advisors. So when you throw a product out there, if you're used to coming from the mutual fund world, which I equate to a country club, it can feel like a jungle and a Terrordome because nobody cares really who your name brand is or whatever. There's some of that matters. Some distribution matters, but even companies like Fidelity, JP Morgan, Goldman Sachs, they have to claw and scratch for almost every nickel they get. And it's brutal. And an advisor will sell you out for an ETF that's just like a basis point or two cheaper. And I've seen it happen. And it is just a brutal, brutal environment where every single dollar has to be fought for, and no one really cares who you are or how much assets you've come with. And that's, to me, why I find it to be a Terrordome, especially relative to the mutual fund industry.
And it really frustrates me that in Europe, we're really lagging behind in terms of awareness of the fees, but also the amount of money which is massive, which is managed passively. So why do you think it is that it's taking longer for the message to get through? And why are Europeans less sensitive to fees than, say, the US? Is it just a matter of investor education?
I do think it'll probably all go the direction it goes in the US, but I have a few theories on this. When you talk to some of the US people who have gone to Europe and for US ETF issuers, and they've really calmed down. They went over there gung-ho, and I think they really are just taking a longer view now. And a couple of things they tell me are, one, just the plumbing. There's just structural issues. It's hard to get ETFs on platforms. And like the way I talked about the system of mutual funds paying brokers, that's still very popular there. And until you change that incentive system and you have more brokers becoming advisors who are based on getting paid as a percentage of their clients' assets instead of getting the payment from the fund company, until that model takes over, it's going to be tough. But once that model takes over and an ETF is put on a level playing field with a mutual fund, an ETF's probably going to win that battle easily. Like I said, ETFs will tend to appeal to people if on a level playing field versus a mutual fund. The other thing is, I think from retail investors in general, this is just, and you may know better than me, but in the US, we're consumers at heart. I mean, the whole US economy is a consumer engine driven kind of place. And there's a lot of do-it-yourselfers and there's a lot of early adopter types here, whether it's technology or with finance or with automobiles. We're very picky, and we try to watch all the dollars here that we have coming in. And so I think that our consumer sense has led us to forcing this issue faster than the average European consumer. But that's my sort of more broad theory, which there's not a lot of data to back that up. I just sense that we're a consumer-based society to the 10th degree here, and that probably helps fuel it a little bit.
And it just seems like US investors are much more engaged with markets. There's much less awareness. I think maybe we should have something like a 401k over here. That might help. But so
yeah, and also, I mean, a lot of times when you show people, when you show people the numbers in certain ways, I think it can really be compelling. Like in terms of, you're going to get like $100,000 less in your retirement. I mean, that really pops for some people, and a lot of the media here has gotten on board with this. I think you saw bloggers talking about it maybe 10 years ago, and then it sort of seeps into the mainstream media. Now I think people here are very tuned into why cost matters. And once you tune into cost mattering, you naturally go to the ETF, because what's interesting is if you look at the average mutual fund fee in the US versus the average ETF fee, it's only half that difference of the average European mutual fund to ETF. In other words, your difference in fee is even greater than ours. And yet in our country or region, you see much more movement to the lower cost. But as soon as somebody figures out the ETF thing over there, they're going to be happy because the average fee is it's multiples time more cheaper on the ETF side versus the mutual funds there.
Yeah, I mean, this is something which I'm pushing quite hard for the people that listen to my YouTube channel. So let me just talk briefly about the time taken, in your view, until we get to a zero fee ETF, because Fidelity has just launched, obviously, these zero cost funds in the United States, but of course over here we don't have it, and it's not wrapped as an ETF over there yet. So how long?
I would say within a year, we'll probably see a zero expense ratio ETF. Now, I'm going to caveat that with a couple things. One, it won't matter unless it's a really big established player like Schwab or Fidelity probably could pull it off to a degree, although they're still small on the ETF side, or a BlackRock. If a firm comes out and nobody's heard of them, or they're small or indie, I'm sorry, a zero expense ratio ETF probably won't matter. It has to be a big guy. So I will caveat it with that, but let's just assume it's a Schwab and it's within a year. I think it will matter, but you have to understand that you already can get an entire well-diversified portfolio of ETFs for a blended fee of about 5 or 6 basis points. So at this point, we're kind of splitting hairs. But I do agree, when Fidelity Zero came out, it was, I think it set the world on fire for a couple of reasons. It was the climax of something we've been building up for 20 years. And it was Fidelity. Everybody thought it'd be like Vanguard or Schwab. And here you have this active giant doing it. And I think that rattled the bones of a lot of the financial industry in particular, because it was like, oh, wow, it's not just the Vanguard, BlackRock, Terrordome thing. This is Fidelity doing it. So I think that's why that was an explosion of public relations and media attention. But the other final point I would say is that in ETFs here, they tend to be able to lend out about a third of the securities. So in some cases, like a total market ETF, like the Vanguard Total Market Fund, they can lend out a third of the stocks, get a little revenue from companies who want to borrow those stocks to short. They put that back in the fund and they make up that fee in the form of perfect tracking. So there are already, quote, free ETFs out there if you consider tracking difference to be the true cost, which us analysts would say that is the true cost. But most people look at the expense ratio. But again, we're talking about basis points at this point. But I would be surprised that, in 5 or 6 years, everybody just sort of expects their whole portfolio to be zero.
And so if these companies are having trouble generating revenue by just tracking markets with beta, and people are moving away from alpha, the only places where they can make money now, things like thematic ETFs and smart beta ETFs. Maybe you could just talk briefly about what smart ETFs and smart beta ETFs and thematic ETFs are.
Sure. So basically, everything that's about to go to zero is what we call plain vanilla or beta, right? It's just the market cap weighted, boom, S&P 500 or the total market, the emerging markets index. That's sort of the core of the portfolio, I think, and everybody's going to expect that to be free. Now, on the outside, you've got things that want to do a little better, because not everybody wants 3 Vanguard index funds and wait 50 years. Some people are itchy. They want to try to do a little better, and that's fine. And I think that's where you're going to have thematic ETFs, smart beta, in pure active or hedge fund strategies. A lot of this is always going to have a market. The question is, how much will fee pressures hit those areas? And we have seen some. You can now get good, solid, well-built smart beta ETFs that do a variety of factors for under 10 basis points. So so it's already getting into the single digits there. Hedge fund ETFs that do long short strategies, those are still more 50, 60 basis points. Thematic ETFs probably are where you're seeing the highest fees and probably where you're going to see the fee war go next, because they're like 60 and 70 basis points, like robotics, cybersecurity, video game products.
But marijuana, I saw that's a big
marijuana,
one.
Yeah.
With the fantastic ticker, POT.
No, the ticker here for marijuana is MJ, and in Canada it's HMMJ. MJ is pretty good, but it could be better. The marijuana ETF is a great example, because if you're a thematic ETF and you that theme kicks in, you start outperforming by 20, 30 percentage points. Nobody cares that they're paying 70, 80 basis points. However, BlackRock has smelled this opportunity. And so you have BlackRock and Goldman now launching thematic ETFs like crazy. So that little party the thematic ETFs have been enjoying is about to get ruined by BlackRock, who is ultimately going to vanguard those categories. they won't come in at single digits, but they're going to probably launch at 30, 20, and ultimately look, anything that comes out and finds a niche for a minute, the time in which it gets vanguarded and the fee war breaks out has been shortened and shortened and shortened. So I do think you're going to find interesting innovations in different areas and themes and strategies, and there'll always be room for a high flyer that just, wows you, and you're going to be okay paying for that. But ultimately, those things are going to get commoditized very quickly and turn into beta, and this is going to be the challenge for asset managers going forward. That's why I think just making money on fund expense ratio is probably going to be something that's going to be tougher. And so these firms are going to look for different things to do. BlackRock's moving into technology and trying to offer tech products. Schwab makes a lot of money custodying the assets and earning interest on that. And so Fidelity, by being so in touch with the customer, is able to, I think, carve out a living with their active funds, which still make a lot. And that's how they can subsidize offering zero expense ratio index funds. So I think these firms are going to have to figure out other ways besides, fund fees to earn a living. But, the earlier and more innovative you are, you probably do have some degree of ability to charge a higher fee. So ultimately, it might look like, the airlines where it's cheaper to do regular domestic flights, but if you want to go somewhere exotic, you may have to pay up for it.
I love that. I love your ability as a wordsmith to vanguard the fees. That's fantastic. Okay.
You know why? Because A, it keeps myself entertained, and B, it just communicates things very quickly and with a little extra, sizzle. Very
good. Okay, so last point, the thing that you're always having to defend, which you're sick of doing, I know, but let's do it again. So are ETFs evil / the cause of the next crisis / parasitic / anti-capitalist?
Yeah, every month or so there's an article that says one of those things, and many people send it to me, and it triggers me, and I have to defend it. Look, ETFs are not perfect vehicles. You cannot compare them to utopia. But if you compare them to what else you have options, you can go and buy stocks and bonds yourself. Go for it. Or you can buy a mutual fund if you want someone else to do it. Or you can use the ETF or something like that. So people tend to pick the ETF within reality as being the best choice. Now, does that mean they're perfect? No. But they're probably not a systemic risk to the whole market, because at the end of the day, ETFs, even in the US where they're huge, only own 8% of stocks. They only own 2% of all bonds, and they own about 1% of all gold, or commodities. So they're pretty small. They're like I equate them to a puppy dog with sharp teeth, right? They're very popular and hot, but they're still smaller than mutual funds. And at the end of the day, remember when there was the internet crisis or the dot-com crisis? Nobody blamed tech mutual funds. It was tech stocks that did it. So, there'll be things in the market that have issues and places people go, but ultimately the ETF is just a portal to get it. And like I said, you are owning the same stocks and bonds that you did with mutual funds, just in a different wrapper. So I don't find them to have a problem. And I'm always watching these sell-offs that happen, these mini spasms we see, and I'm monitoring, are ETFs doing anything wrong? And honestly, they take a pounding. I mean, they trade double, triple their average, and they're fine. And they actually, if you want to be optimistic, they provide a nice liquidity buffer for the stocks and bonds, and a place where market makers can go and just trade shares with each other, and they're happy. And then only about 10% of ETF volume involves buying and selling the underlying stocks, which is creation redemption activity. So in many ways, if you talk to market makers and people inside, they're like, I love them because they provide another liquidity avenue for me when I'm making a market and trying to make all my customers happy. So I personally think they're a good thing, but look, if they start to own 50, 60% of the market, you could start having problems. I do think they should live in their lane. I don't think they should take over, because you don't want them vampiring away too much liquidity from stocks and bonds. You need those things to be nice and liquid. The better the more liquid those underlying markets are, the more the ETF operates at maximum efficiency and provides the best deal for investors. So I'm closely monitoring it. So for now, I don't see any issues at the size they're at.
So for something like a high yield ETF, where you've got a very liquid wrapper and an illiquid asset, I guess if there's a crisis, suddenly all that liquidity that you see at the ETF level will suddenly become the liquidity of the high yield bonds which are underneath. Is that the
So
risk?
even here, we have a traffic light system that's akin to movie ratings, and we do give HYG or high yield debt ETFs a yellow light just because they have, quote, less liquid holdings. And you should go in, again, you got to compare it to reality. You're going to buy high yield junk bonds yourself? Is it going to be easy to sell those on a rough day? No. You're probably going to be able to sell the ETF easier, frankly. But on those rough days, you probably have to pay some degree of a premium to get out of the fund. It might be 50, 40 basis points. But this is just a bad day. Bad days are bad days. So you got to compare it to reality. But ultimately, HYG is now 12 years old. It's lived through 2008. It's lived through many spasms. And it trades fine, does fine. In 2008, in fact, it actually took in money during the worst part of the rout. It went down 10% over 6 weeks, took in some flows. And look, there's a lot of companies out there who are just waiting for high yield to have a sell-off. They're like, they come in and they want to buy low. So, I mean, ultimately, there's probably going to be a buyer waiting, and there will be a bottom. But look, there's times in a huge sell-off where it's real nasty, where it's just difficult it might be a little tougher for the ETF simply because it's going to be tougher for high yield debt to be sold. So I always equate high yield debt ETFs to owning beachfront property in Florida. It's beautiful, it's convenient, you love it, but you better expect the occasional hurricane. So you got to go in with knowing that, hey, I'm buying junk bonds here. Don't go in with a fantasy thinking this is just like SPY. And if you go in just with reality in mind, and you think about what it is you're actually buying underneath the ETF, you probably will be fine. You just shouldn't expect utopia.
Sure. And your book, the Institutional ETF Toolbox, so is this only written for institutional investors, so i.e. people like insurance companies, pension funds, hedge funds, or is it for kind of mom and pop investors who are the kind of people who listen to my channel?
Yes, totally for mom and pop. In fact, I really wish I called the ETF Toolbox. Because when you put institutional in the title, you scare off 99.9% of the public. And although you do capture a small percentage who are looking for something, the only reason institutional is in there is because I do talk about how some of the bigger players use them. But ultimately, this thing is a great primer, and it's written in the way I just spoke to you now. It's very conversational. I've been taught to just, writing should be like you're on a date with somebody. You're just speaking normal, and I wrote that way. I didn't want it to sound like a textbook. So I've found that most people have been able to use it as a primer for getting into the ETF market. So you could say it's a primer book for regular people with the added bonus that I also talk a little bit about how some of the bigger player types do use ETFs for their day-to-day management of their portfolio.
Because I noticed that was a big change when I was a strategist, that, over time I found more and more of the clients were doing asset allocation, but just using ETFs. I mean, they weren't buying single stocks or single bonds. They were painting with this very broad palette of ETFs.
Yeah, a lot of people have said that ETFs they're great for asset allocation, and they're great for active management in the vein of an economist. You're setting out your portfolio. You are, maybe you're bullish China, but you don't have time or the resources to go in and figure out which stocks within China you should buy, so you buy the China ETF. And whereas I think a lot of active in traditionally is known as picking the stocks and bonds. That will still exist, and that's fine. And there are active ETFs, which if you want to go active, say in like high yield or with equities, you can plug, ETFs have that too. But ETFs mostly, I think, I agree with you. They're like puzzle pieces to a portfolio, and you just snap them in exactly as your fit. And institutions have been doing this for a long time. That's how they make a portfolio. That's how everybody makes a portfolio. And the decision on how much to be in equities and fixed income or international or commodities, those decisions make up the vast majority of your returns more than the security selection within that asset class. So essentially, the ETFs you pick and the weightings you give are ultimately how is going to drive almost all your performance anyway.
Well, that was fantastic, Eric. Thank you so much for spending this time with me and talking about your book as well. And hopefully we'll be able to talk soon when the big sell-off happens and you can show why ETFs weren't the cause.
Well, thanks a lot. It was a pleasure chatting with you.
So welcome to the Terrordome. I love that description. And hopefully Europe also becomes part of the Terrordome as we get more awareness of fees over here. Now, if you want to support us and you're willing to pay $5 a month or more, you'll be able to take part in our live Q&A sessions and ask me any question you like. Or preferably, you'll pay $10 a month or more like Kishore Bhagwat, Robert Bradbury and Ian Stenton. And hopefully we'll see you there during the live sessions. So as always, thank you for listening.